Hi team, we are here today talking about double declining balance depreciation, my absolute favorite. So I'm really glad you're here. Let's jump right in. On October 1st, the company purchases a $75,000 truck with an estimated salvage value of $5,000. The truck has an estimated useful life of 4 years and 120,000 miles. Calculate depreciation using the double declining balance method for each year of the asset's life and also record the required journal entries. Okay, so with double declining balance, you'll set up a table, and I'm going to leave a little room at the top so we can do a calculation in just a second. So I'm going to scooch down a little bit, and we're going to just keep track of the years here. So year 1, year 2, year 3, year 4, and you can see we started partway through the first year in October. So that means we'll have 3 months of depreciation in year 1, October, November, December. And that means the other 9 months of the asset's life are going to be recorded in year 5. Probably. That actually doesn't always happen in double declining balance, depending on how high the salvage value is. But I'm going to put it in there anyway, and we'll see what happens. We'll see how it turns out. Okay, our next step is to take the cost of the asset minus accumulated depreciation, and that equals net book value. So I'll just put that abbreviation down here. So net book value, net book value. So cost minus accumulated is net book value. I guess I should put accumulated depreciation down here too. Okay, then you're going to multiply by the DDB rate. So whatever your double declining balance rate is, I'll show you what that is in just a second, and then that is going to equal your depreciation, usually. Again, we'll talk about the exceptions to that. So let's fill this in. So for cost, the cost of our truck was $75,000. So we paid $75,000, that's the cost. I have a table or a T-chart for us for accumulated depreciation. In the first year, accumulated depreciation is 0. There is none. So net book value will be $75,000 minus 0 will equal $75,000. Then we need to multiply it by the DDB rate. The DDB rate, double declining balance rate, is double the straight line rate. So to calculate the straight line rate, you're going to take 100 because it's 100% of the asset. So you'll literally always do the number 100, and then you'll divide by the number of years. So in this case, it's 4 years. So 100 divided by 4, that gives us 25%. So if we were doing straight line, we would take 25% of the asset's cost every year for 4 years. With double declining balance, you're going to multiply that by 2. So our DDB rate is going to be 50%. Okay, I want to just show you a couple more of those. So this is what it is for this asset, but I want to make sure you understand how the rate works. So let's just jump down here into La La Land for a second, and let's see what it would be if we had a 3-year asset. If we had a 3-year asset, you would take 100 divided by 3. That would give you 33%. Then you would multiply it by 2 for the DDB rate, double declining balance. That'd give you 66%. If you had let's say a 5-year asset, then you would take 100 divide by 5. That'd be 20%. You would just take that and multiply it by 2. Okay, so that's how you calculate the DDB rate. Take 100, divide by the number of years, and then multiply by 2. So you'll notice in our data set they gave us miles. Miles don't matter when you're looking at double declining balance. Okay, so I'm going to delete these numbers just to clean things up a little bit so it's not so messy and confusing. So then we're going to take our $75,000, our net book value, and we're going to multiply by our DDB rate, that 50%, and that gives us $37,500. That would normally be our depreciation expense for the year. However, we are going to have another column for actual depreciation because remember, we didn't own this asset for a full year. We only owned it for 3 months, all of October, November, and December. So we're going to take this $37,500 and we're going to multiply by 3 12s, 3 out of 12 months. That gives us $93.75. So our first year of depreciation is $93.75. If we do the journal entry for that, it's going to be debit to depreciation expense and a credit to accumulated depreciation. And this will be for $93.75 and $93.75. Put that over here. Okay, so that means because we're crediting accumulated depreciation for $93.75, that's what's going to go here into our T account, $93.75. I'm going to do a total so we can keep a running total of how much we have accumulated. And here's the trick with salvage value. With double declining balance, you cannot depreciate below salvage value. So that means we have to leave $5,000 undepreciated. So that means the most we can have in our accumulated depreciation account is $70,000. So I'm going to put that down here just to keep us on track. $70,000. This is our max that we can have in the account. That's the $75,000 cost minus the $5,000 salvage value. So $70,000 is the most. So right now we only have $93.75, so we can have $60,000 additional or more. That's how much more we can still record before we hit our max. Okay, whew, this is so fun. So let's do year 2. So in year 2, again, we're going to look at the cost of the asset. The cost of the asset never changes. We still paid $75,000. That doesn't change unless you make a significant improvement or something like that. So I could take this $75,000 and I can carry it all the way down right now. That's always going to be the same. The cost is the cost is the cost. You paid $75,000 for it. That's the end of the story. For accumulated depreciation at this point, the total is $93.75. So this is going to say $93.75. That means net book value is $75,000 minus $93.75. That gives us $65,625. This DDB rate is always going to be the same. It's going to be 50% the whole way through. So I just carried those down. So again, we're going to take our net book value times our DDB rate. So 65,625 times 50%, that gives us $32,812.50, and that will be our depreciation for the current year. So the journal entry for year 2 will be debit depreciation expense for $32,812.50, credit accumulated for $32,812.50, and we'll plug that into our accumulated account. So you can see now our total and accumulated is $42,000. Remember, we can keep going until we hit 70, so we have another $27,000 to put in that account. Okay, year 3. So cost is $75,000 minus accumulated, which is now this number, $42,187.50. Net book value is the difference, $32,812.50. So we're going to take net book value times our DDB rate. That gives us $16,406.25. So we just want to make sure that still is working, and it will, because we can hold another $27,000. So $16,406.25 is fine. It's not above our max. So that means our journal entry for this year will be debit depreciation expense for $16,406.25, credit accumulated for $16,406.25. Okay, almost done. So year 4, $75,000 cost. Accumulated is now $58,593.75. That comes from right here, $58,593.75. We're going to take the difference to get net book value, what it's worth on our books, the net book value. We're going to multiply that by the DDB rate, 50%, and that gives us $82.03. We can still record that full amount because we have $11,000 still that we can hold in our depreciation account. So that means our journal entry this year will be debit depreciation expense and credit accumulated depreciation for $82.0313. We're going to record that in our T account, and that gets us up to $66,796.88. Okay, so final year. Things are a little bit strange in the final year of a DDB asset. So now we have 75,000. We're going to subtract our accumulated of 66,796.88. Oh, Excel has gotten smart on us. It's auto-filling, so now it's taking the difference, 8203, which is cost minus accumulated. And it's done this calculation. So 4101 is the net book value times 50%. But you can see that that would be too much. 320312 is the most we can fit into our account. So if I just plug in this 410156, you can see we go over 70,000 and we're not allowed to go over 70,000. Another thing to think about is that we bought the asset in October, so technically we should only be taking 9 months. But here's the story with double declining balance. In the final year of the asset, you just take what's left. So you just take what's left. You actually don't even really need to do this last calculation. In the final year of the asset, you take what's left. So this actual is going to be 320312. Because we have this calculation here, right, which is the 70,000 minus what's already in accumulated. And so this will give us 320312 here, which will bring us up to 70,000, which is the max. So in the final year of the asset, just take whatever's left. Make sure you don't depreciate below salvage value. Leave yourself whatever your salvage value is. So you can see, although our cost was 75,000, our salvage value is 5,000. And so we left ourselves that space, that 5,000. So in the final year, our journal entry will be debit depreciation expense of 320312 and credit to accumulated of 320312. Okay, team, that was it. That's the most fun one. So I hope you had as much fun as I did.